Welcome to the Explainer. You know, private equity funds are a huge deal. They move billions of dollars around the globe, but they often operate behind closed doors, governed by this complex, almost hidden set of rules. So today, we're going to pull back the curtain and open up that investor rulebook to really understand the language that controls this high-stakes game. But here's the thing. To see how these rules actually work in the real world, we're not just going to throw a bunch of definitions at you. No, we're going to follow a story. So, let's meet the cast of characters in our little drama. We've got the fund itself, Falcon Crest Fundi. We've got its manager, Crest Asset Management. And most importantly, we have two of its key investors, who we'll just call LP Alpha and LP Beta. Following their journey is going to make this whole rulebook come alive. Okay, let's dive right in. Now, everything, and I mean everything, starts with the investor's money. But here's the catch. Once you commit your capital to a private equity fund, you can't just wake up one day and ask for it back. And that brings us to the first really critical rule of this handshake. It's called a lock-in period. For our investor, LP Beta, their money is locked in for 2 whole years. Now, that might sound a little restrictive, right? But it's absolutely essential. It gives the fund manager, the one thing they need most, stable, predictable capital to make those big, long-term bets without constantly worrying that investors are going to pull out at the first sign of trouble. All right, so the manager has the capital and they start generating profits. Great. Now they get to take a cut, which is known as a performance fee. But how do you make sure this fee is actually fair? How do you know you're rewarding real skill, not just dumb luck? Well, the rulebook has some pretty clever mechanics for this. And the most important of these rules is the high water mark. Honestly, just think of it like a video game high score. The manager can only earn a performance fee on profits that push the fund's value above its previous all-time peak. What this really goes is protect investors from paying fees on the same gains twice if the fund's value dips and then just recovers back to where it was. Let's watch this play out with LP Alpha. In year 1, their $10 million grows to $12 million. Awesome. The manager gets a fee on that $2 million gain, and boom, the new high watermark is set at 12 mil. But in year 2, the value drops. No new peak, so no fee. Now, watch what happens in year 3. The fund recovers to $13 million, but the manager only gets paid on that $1 million of new profit above the old $12 million mark. See, that's the rule right there, protecting the investor. So, when did these fees actually get paid out? Well, that process is called crystallization. You see, throughout the year, fees are being calculated and set aside. They're what we call accrued. But they only crystallize. That is, they turn into a real cash payment to the manager at very specific times, which is usually at the end of the year. But that brings up a huge question. What happens if a manager gets this massive crystallized bonus one year for amazing performance, and then the very next year, the fund's value completely tanks, wiping out all those gains and then some? Let's go back to our fund, Falcon Crest. In year 1, it did incredibly well, generating an $8 million profit. The manager, Crest Asset Management, took home a very handsome performance fee of $1.6 million. And then, year 2 happened. The market turned, and the fund lost a whopping $6 million. All of a sudden, that huge performance fee from year 1 doesn't look quite so deserved anymore, does it? This, right here, is where the partnership rules are truly put to the test. So the big question is, does the manager actually have to give that money back? The answer brings us to one of the most powerful and, frankly, one of the most important investor protections in the entire private equity rulebook. It's called a clawback provision. This is a rule baked right into the contract that says if the fund's long-term performance doesn't actually justify the fees that were paid out in those good early years, the manager has to give them back. The bottom line is, a clawback makes sure managers get paid for the fund's overall success, not just for one lucky year. And for Crest Asset Management, that clawback was very, very real. After those losses in year 2, the fund's total profit over its life was only $2 million. The fee on that should have been just $400,000, so the manager had to return $1.2 million of their original fee, bringing their pay right back in line with the fund's actual long-term results. Now, things get really interesting when you think about what happens after a bad year like that one. I mean, what if that $6 million drop spooked not just LP Alpha, but all the investors? A panicked rush for the exits can literally sink a fund. Yeah, a rush for the exit is a manager's worst nightmare. It can be absolutely disastrous.
So, to prevent that kind of crisis, the rulebook gives managers a whole toolkit to control the outflow of cash and, really importantly, to protect the investors who decide to stay put.
These tools are all about managing potential chaos. If there's a panic, a manager can put up what are called gates, which basically limit total withdrawals for a while, just to slow things down. Or they can use swing pricing, which is a really clever way of making sure the people rushing to sell are the ones who cover the extra costs, protecting everyone else. And in a real emergency, there's something called in-kind redemption, where instead of scarce cash, you get paid out with some of the assets the fund already owns, like stocks. Okay, so beyond these core rules of the road, managers have a couple of more advanced tools they can use to navigate really volatile markets. Now, these strategies are incredibly powerful, but they also bring in a whole new level of complexity and risk. One is short selling. You can think of this as being a professional pessimist. You borrow shares, sell them immediately, and then you really hope, the price plummets so you can buy them back for cheap and pocket the difference. Then there are derivatives. Think of these as complex side bets on the value of an asset without actually owning the asset itself. They're complicated contracts that need really careful management, but they let funds make incredibly sophisticated plays in the market. So let's just pull all of this together for a second. This rule book, it's really a system of checks and balances, right? The high watermark and the clawback make sure managers are paid fairly for real long-term results. The lock-in gives them the stability they need to do their job. And then tools like gates and swing pricing act as crucial safety valves to protect the entire fund if a crisis hits. Every single one of these rules, from clawbacks to gates, is designed to create this finely tuned balance of power, this delicate dance between the investor who puts up the capital and the manager who puts it to work. It's a constant negotiation, and it shapes the risks and rewards of one of the most powerful forces in modern finance. And the big question, the one that continues to define the entire industry, is whether that balance is right.